Let's talk about credit for a moment. You've got about $5 billion under management and opportunistic credit. Tens of billions of dollars more are being raised by other investors for credit opportunities. Effectively, the same thing. How is anybody going to make any money, Jimmy, if there's so much competition? And furthermore, if the Fed is effectively backstopping the corporate bond market?
Mm-hmm. So, in a way, this ties back to the earlier part of the discussion, which is one of the greatest credit investing opportunities in history is the one that came and went before anyone had time to raise all those funds. And in a way, those are related points. If the world had billions and billions and tens of billions of dollars of risk capital to deploy in March, well, then pricing wouldn't have done what it did in March. And so I think the key, again, for us, whether it's in those credit funds or in those multi-strategy funds, is being able to be that liquidity provider when it matters. I think as it relates to capital that's continues to be raised, back to the other part of the earlier discussion, this is going to be going on for a long time. There will be defaults. There will be stops and starts. You know, today I use this example a lot. Pre-COVID, the U.S. high yield market, at least for a moment, traded something like 350 basis points over risk-free. So the average high yield bond was 350 over. And at that time, and this has been going on up and down for the last several years, at that point in time, there was plenty of capital being raised that were called activation funds. And the activation funds needed to be activated upon some event. And that event was typically something like high yield going to 700 over or 750 over. Because at that moment in time, if high yield, everybody thought, ever got to 750 over, well, then that's got to be an unbelievable opportunity to deploy capital and credit opportunistically. That's where it is today. The US high yield market today, depending on which bank's index you want to use, is something in the zone of 700 over. So here we are today where the market is trading at the level that people said, I only hope it goes there so that the fund can activate and I can participate in this opportunism. It's trading there today. So again, I think it's both. I think there is and continues to be a terrific possible money-making opportunity in credit. But it certainly won't look like the March 23rd lows.
One of the four businesses you're in is structured credit and CLOs, and those businesses thrived in the decade after the financial crisis. What's the future for them now?
I think it'll be similar on the way out of this recovery. It may take a little while longer to get there, and the exact shape of it is unclear, but that growth in largely the CLO market, but really it was just credit creation. There was an incredible amount of credit creation in the decade after the financial crisis. And whenever there's that much credit creation, there's going to be structures for that credit to sit inside of, get distributed, get sliced and diced, get owned, and ultimately get managed.
We got to the point in January and February where many people were starting to sound the alarm about the amount of leverage, on corporate balance sheets and the amount of leverage in credit markets and sovereign bond markets together. If we're going to have even more, are we not just inflating a bigger bubble to burst when the next downturn comes along?
I think a little yes, a little no. And what I mean by that is what happened here to the economy was probably almost singularly unique in history. Meaning the economy was moving along and then subsequently ran into a multi-month, I'll call it revenue hole, right? And there's all kinds of different ways to measure it. You'll hear people quote that phenomenon a lot of different ways, but the world wasn't built. When I say the world, companies, consumers, the high end, the low end, mall owners, lenders, whoever it is, the world's not built for the zero revenue scenario. And so a certain amount of what happened was the government in a way doing its job, which is when something extraordinary happens, the government's the last line of defense. And so you can look at a lot of those dollars, whether they're the direct dollars or the indirect dollars, as the government filling a revenue hole that otherwise would have cascaded into an even worse outcome for everybody. Now, too much of a good thing is can be risky. And so there's talk of moral hazard, and there's talk of whether the high yield bond buying part was necessary and so on. But big picture, there was a $10 trillion hole in the economy, and the financial markets seized as a result. And so the government in part filled the hole and then did a variety of things to unglue that seizure.